Good morning and welcome to the Forex Daily Update, brought to you by Pepperstone on Thursday the 20th of December 2018. I'm Darren Sinden. You can follow me throughout the day on Twitter by using @ds_Pepperstone. Alright, let's kick off with a look at the overnight changes and price moves to be aware of. But please note that we're going to be taking a break from the daily updates over the Christmas period, and we'll be returning with the videos on the 2nd of January. So tomorrow's video will be, Friday's video will be the last one in calendar year 2018. Okay, well, let's take a look at the changes. We recorded this mid-morning in London, so these are moves that we've seen across the London session, and really it's a story of pushback by the majors against the US dollar. You can see gains for the euro, gains for the pound sterling, the Australian dollar and the New Zealand dollar all on the front foot, and the Japanese yen firming as well. Dollar index for its part decidedly on the back foot, down by around 0.8% to trade at 96.26, though it has been lower this morning, has certainly sold off lower than there. The South African rand was also a decent gainer against the US dollar, with a move of just over 1% to the good against the US currency. Perhaps the biggest surprise of the day, though, double-digit gains for Bitcoin and a 9% rise in the price of Ether as well this morning. Okay, let's take a look at what's on the calendar, events that may move the markets today. Of course, we've already had much of the data out of the market this morning. We had some decent unemployment numbers out of Australia, I should say. We also had the most recent Bank of Japan interest rate decision. No change there, of course. The bank stays with rates where they are and continues with QE. We also had retail sales data out of the UK, and we'll look at that in a bit more detail momentarily. To come momentarily, we will have the Bank of England's final interest rate decision for the year of 2018. No change expected, and no change to QE. Of course, the market will scrutinise the minutes closely to see how the MPC members have voted and what their views are about rates going forward. Moving forward then, at 13:30 GMT, we'll cross over the Atlantic for continuing jobless and initial jobless claims out of the USA. That'll be followed at the same time by perhaps a slightly more important number, the Philadelphia Fed Manufacturing Survey for December. This is a data-rich survey, I think would be the way to describe that, that looks at the performance of manufacturing industry in particular across the USA. And then at 23:30, after a decent break, we'll have a national CPI, consumer price index data, that is, out of Japan for the month of November on a year-on-year basis. Okay, breaking news and comment then that's caught my eye today, and first of all, as you're probably well aware, the US Federal Reserve raised interest rates in the US by 0.25% and forecast that it would move 2 or 3 times more in 2019. Now that's less than some interest rate hawks like Goldman Sachs were forecasting, but more than an increasingly dovish market was expecting. Some were hoping, in fact, that the Fed would skip the December rate rise and would look to talk the markets down from an expectation of many quarterly rate rises perhaps in 2019. They've done that to some extent with this 2 or 3 times comment, but not completely. UK retail sales for November rose ahead of expectations, up by 1.4% month on month versus forecasts for growth of just 0.3% against an October read of 0.4%. So a significant beat, although the small caveat there is that significant beat was largely bolstered by sharp discounts over the Black Friday and Cyber Monday periods. European equities have taken Wall Street's lead and have sold off after the Fed decision. The EU 50 index, for example, is down by more than 1% as I speak. Okay, time for food for thought and something to take away with you into the trading day and beyond. Why not think about this? A couple of slides from the most recent Bank of America Merrill Lynch FX survey, a survey of some 63 fund managers with assets under management of over $609 billion. A couple of questions. Firstly, where do you see the rest of the world and US growth recoupling, or how is that likely to come about next year? 64% of the fund managers surveyed said that would happen through US growth slowing to drop down into line with the rest of the world. Another 24% felt that the US would continue to diverge from the rest of the world. So slightly take your money, pays your money, takes your choice there, but on balance, the majority of the group there more bearish about the prospects for the US. And then switching to the fund managers' thoughts on ECB rate hikes in the future now that the central bank has finished its quantitative easing program. 41% of the fund managers that were surveyed believe that that won't happen until December 2019. That was up sharply from the last time the bank asked this question in October, where only 16% of managers felt that would be the case. And there were some other significant changes too. A much bigger jump in the number of fund managers who believe that the ECB won't actually get to raise rates at all. That jumped up to 14% from October's 8%. And a sharp jump as well in those that think it will happen in 2020. In October, only 2% of fund managers surveyed felt that was the case. And for the most recent survey, the figure came back at 8%. So some very interesting data there as well. Okay, please take a moment to read this risk warning. Trading CFDs and foreign exchange on margin can be risky business. If you're in any doubt about those risks or the suitability of leverage products for you, then please do contact your Pepperstone account representative and do take a moment to read this risk warning thoroughly. Thank you for your time.